Okay, as I mentioned, you guys, this is being recorded. One thing I say at the beginning of every single webinar is watch this again. You don't have to watch this long straddle webinar specifically, but another long straddle webinar would suffice, you know, ones that I do because I have specific rules and stuff. Because it'll help you remember it a little bit longer. And maybe especially if you're newer to trading, those nuances, the first time through will fly by. Second time through will solidify it into your longer term memory. You know, if you watch it once, it's going to go into your short term memory, and a month down the road, you're going to have to try and figure it all out again. So it'll be like learning it new. So try and watch it again. And like I mentioned, this is options for any directional bias. We are going to start out this webinar where we have a directional bias, as in, well, I just don't think it's going to stay right here. And the way the economy is right now, you know, it could go in either direction on a whim. You know, we've seen the markets really have some major moves, even off of tweets from Trump or even words coming out of China. So that can send us in any direction at any moment. So that would be the right type of environment for something like a long straddle. Or, you know, depending on the environment, you know, we have done the butterflies before this, 1 and 2. You know, those butterflies are great for a specific type of environment, whereas this one does as well. So that's how we're going to go through it. We start out this webinar, we have a bias. We don't know which way it's going to go. We just don't think it's going to stay here for very long. We think that there's going to be a big move ahead of us. But let me get a couple of things out of the way real quick. My name is Eric Wilkinson. You may recognize me from mainstream media as the Wolfman. I actually started out trading in college with some money I had earned and was trying to get a psychology degree at that time. Decided to flip it over to finance. After graduating from college with a finance degree, I moved straight to Chicago and walked onto the floor, got a job, and you know, basically been trading ever since, and traded everything from stocks, financial futures, commodities, currencies, and options on all these markets in just about all market conditions. All right, so I got to go over this too. Basically, this says anything I say in these videos or webinars is for general commentary. All right, we're actually here to teach you guys how to implement a strategy. Anybody can teach you how to build a strategy, okay? Especially the long straddle. Probably one of the easiest strategies to understand or learn, really, or actually build. I can't really say understand because there's a lot of things that go into it that help you understand. But it's very easy because it's basically you're buying the at-the-money call and put. I mean, really, that's all there is to it, right? No, there are specific rules that I need you guys to follow before implementing this strategy because it will increase your probabilities of success. If you set this up, you know, willy-nilly, you aren't probably putting your best foot forward, all right? So bottom line is do your own homework. Past performance of any trading system or methodology is not necessarily indicative of future results. All right, you guys can follow me on Twitter at Wolfman's blog or our parent company at ProTraderStrat. Also, we are really ramping up our Facebook. So at ProTrader Strategies, you can get all kinds of videos, daily market commentaries, some of these webinars and stuff like that. We put a lot of content out on Facebook now too. So check us out there. All right, like I mentioned, this is the long straddle. But one thing I want to go into this webinar with a mindset of we don't know that we're doing the long straddle. You don't come into a today when we're trading like a day trade, you know, a trade like today where we go into the markets and say, you know what? I really need to put on a long straddle. Nobody does that. Nobody comes in and says, you know what? I know I want to do a long straddle because I'm going to buy the at-the-money put and buy the at-the-money call. Well, I will tell you that if you set it up incorrectly, this can go south on you very quickly. All right. You could lose some money, even if you got a big move. All right. So, I'll show you how to set this up correctly. One thing to note, we want to try and make it delta neutral. that means that we actually don't have a bias at all. Now, I don't have a problem. Say, for instance, you think the market is going to really have a big move higher, but hey, you know, we just got a yield curve inversion or whatever, so I'm worried about the downside. But I believe I'm a little bit more biased to this upside. Well, in that case, then maybe you would want to go positive delta. And if you were leaning towards a little bit to the downside, you could go negative delta, right? So, but we want to get as close to delta neutral in this strategy as possible. It'll make it work out the best. All right, so one thing that this is kind of like on the Analyze tab, what it's going to basically look like. You know, we're going to have our break evens out here and here, and you know, if it stayed right where we are, we're going to lose the maximum amount of money. But having said that, we do have some great upside and downside potential with this one. All right, one thing we have to know when we're building this strategy out, one thing is we haven't gotten to that we know it's a long straddle. So let's kind of try and put that outside of our mind. We know we're coming to it, but just play this out with me like we were coming into the day and we found a stock that we wanted to trade. So we came in here to do this. So I'm going to pull up, picking the right underline. When I pull up my platform here, what I want you to do is, let's just say we thought this was going to happen in XLK, maybe, I don't know. But first thing you do when you're picking the right underline, we have an assumption that we think it's going to make a big move. I want you to go and see it's a $76 underlying. So XYZ, we could even say, is a $76 underline. My rule with this, picking the right underlying, is that we need to have the bid ask less than 10 cents wide. So we were looking for less than 10 cents wide. Come on now, baby. Why aren't you working for me? Less than 10 cents wide, all right? Down here. So we are looking at the ones that are actually the spot month. So this isn't the spot month. It's a little further in duration, but we want to go to the spot month. Closest to 35 days to expiration is really where most time and volume is being traded. And XLK has got some crazy markets in there, so we're going to pick something else. Let's look at Facebook. So after the close, obviously, like we saw in XLK, a lot of orders get canceled, okay? So we need to implement this rule during the open market session, all right? Not even after hours and stuff like that, during open market, all right? So with a stock that is, all right, now we're on to greater than. So on a stock that's greater than $100, all right? What just happened? All right, so on a stock over $100, basically what we're going to do is move the decimal place 3 ticks to the left. 1, 2, 3. So that makes that 18 cents wide. My rule then would be, we got 18 cents. My rule then, we need to look down here to the spot month with 36 days to expiration. And the ones that are just out of the money need to be from the bid to the offer about 18 cents wide. Now, we can see this is after the market and a lot of orders have been canceled and stuff like that. So it's a little bit wider. So that's why we want to look at this during the open market session. So on a stock over $100, 3 ticks to the left, and we come up with 18 cents. Now, if it is a stock that is less than $100, then what we want to do is anything that's less than $100, all right, we need it to be equal to or less than 10 cents wide. I guess it doesn't like my finger touching it. So equal to or less than 10 cents wide. Again, that's here. You can see 5 cents, 5 cents. So that would fit this rule even outside of open market session. So that's what we're looking for to know. Why do we want that? It tells us that there is a lot of volume and open interest going on any given day, all right? So we don't have a ton of volume going there, but a lot of open interest there. We could even go to look at Facebook and see that, you know, a lot of open interest over here, a lot of volume going on. That means there's a lot of eyeballs, okay? And when there's a lot of eyeballs, it means that I don't have to give up very much edge. You know, if it was a really wide market, I might have to give up 10, 15 cents to get in, or maybe even 25 cents to get in some cases. Whereas here, I probably could just put in a $6.05 bid, and I might very well get hit. All right. The reason why you want a lot of things, or a lot of participation in there, because think about it, these guys have spreads and stuff like that. So there's spreads making better markets inside of here that you aren't seeing. And the reason why is because they can't show a market that is leaning on a lean, is what it is. Basically, if there's a 6.15 here, this $4 offer is leaning for somebody's spread. Like they'll sell the 190 calls to buy the 185 calls. Well, this is an outright market where I've got 100 at 6.15. Well, the guy that comes in with a spread that he wants to buy, all of a sudden his market now goes to at $4. Okay, because he'll sell the $4 to buy the 6.15. Well, then this one may very well be offered at $2 and say 34 cents because somebody else has a spread in there. But the spread, if I came in 234 bid, the spread legger would hit me on my offer, or hit me on my bid, and then buy that $4 offer. Okay. It's a little bit confusing. It's something that we learned, you know, we used to, that's how I made my living on the floor. It was basically being a lean on a lean and stuff like that, knowing where all the spreads are. Well, you can't really see that in this day and age. So just know there's better markets out there that you might not be seeing. So don't give up a ton of edge, especially when there's a lot of volume and open interest going on. But at the end of the day, remember, picking the right underlying, over $100 stock, move the decimal 3 ticks to the left. That's how wide we should, inside of that is how wide these markets should be. And if it's less than $100 stock, just know it needs to be 10 cents or less on that, okay? And then picking the right environment. This is where the rubber meets the road, you guys. This is where you need to know what you're getting yourself into, because if you came into the market and decided to do a long straddle because you thought there was going to be a massive move, especially like right now, what we're seeing going on in the market, you might be saying, oh my God, this is the best thing ever. The long straddle is exactly what I need right now because of the market volatility that we're seeing. No, that's not necessarily the case. We need to set this long straddle up in the right environment in order to make sure we are setting ourselves up for success. So hold on a second. Thomas, I'll give an example, Thomas, in just a minute on Tesla, but when I get to that, all right? Does that work with commodities also if we want to go to corn or wheat? I love it. Yes, this will work with futures. Just make sure that you are following these rules. Now, with the futures, you're not necessarily going to have to worry about picking the right underlying, right? There's tight markets in those things. There's a lot of volume and open interest. But the key here then would be that we need to have the right environment, okay? That's going to be the star. We need to have the right environment. This is one of the major differentiators here on what we're looking for. And picking the right environment is that we want really low implied volatility percent. So we want as low IV percent as we can get. All right. Now, what is IV percent? Some of you guys may be new to this. IV percent really tells me where this underlying's volatility is in relation to where it's been in the past. Okay. Because just like we see on the charts for a stock, right, or a commodity, we can see where there's support and resistance on these things, right? Where they get to extreme highs or extreme lows. Well, similarly, we see that happen as well in the markets. We see that happening as well when we look at the charts here. So, you know, I mean, don't look at my Fibonacci's really, because this is old. I mean, I don't even remember the last time I traded Facebook, to be quite honest. So here, I'll just delete it. Remove that drawing. It doesn't really matter. But what we can look down here is, you know, you could actually throw Fibonacci on these, really. You know, I've never even really thought about it, but I know you can. thought about doing it anyway. But what we know is it gets to extreme highs and extreme lows, right? Well, I don't know that there's necessarily a Fibonacci relationship with volatility, to be quite honest. But what I want you to know is you can see when Facebook gets to this extreme up at, this is your volatility over here on the side, tells you what the volatility number is, 56, right? Well, 56 for Facebook is extremely high. But here you go, Thomas. If we go and look at Tesla, we can see 56 is pretty low for Tesla. I mean, the high is like 110, low here, 56 would be somewhere down here. So it's in the lower range. So where Tesla rarely gets, that's the extreme high for something like Facebook. So just knowing what volatility is for that underlying, this 36 number down here, means nothing, okay? Well, it does mean something, but it just really doesn't hold a whole lot of water for us, okay? What we want to know is what volatility is now in relation to where this has been in the past, because volatility will determine our option pricing, all right? So if you want to buy something, do you want to buy it when, it's like going out and buying water after the hurricane, right? You're paying a premium after the hurricane because everybody's desperate to get it, all right? You don't want to do that. You want to buy the water before the hurricane, all right? When you see the hurricane coming, or you have a market, or you have a weather assumption that the hurricane is coming, you go out and buy water. Same thing here. When you start to have an assumption that things are going to get jiggy and there's going to be a big move, well, then you kind of expect volatility to expand in that kind of environment. So you want to get in right before that and do this type of strategy, okay? Because we want really low implied volatility percent. That being said, our implied volatility percent, we want to be for a stock. Let me get rid of this for a second. So picking the right environment for a stock, we want IV percent to be less than 50% for a stock, and we want it to be less than 30% for an ETF. Okay? Now, if you have really low risk tolerance, all right, or maybe not even a whole lot of margin or something like that, you're worried about margin and or the cost of this strategy, well, then maybe look at it with less than 25% here and maybe less than 15% on the ETF, okay? But ultimately, we want extreme low, all right? Lows. All right, I want it as low as it can because then the probability, I mean, we saw that other stock there, right, where we know that they get caught in a range, but we also know when they get way down here really low, they have a tendency to start rising. It can't really stay down there that long. Just like when it's really high, it comes out very quickly, right? So we want to get something when it gets way down here, and that's because the market's complacent and they don't stay complacent very long. So you want to get into this when there's a really low implied volatility percent type of environment. Because then we know those premiums that we're going to be trading this strategy with, the premiums we're going to be buying are at the lowest level that this stock usually gets. It's the cheapest you could ever really buy an option. I had stock stuck in my head. It's the cheapest you could buy an option, all right? Just like when volatility is at extreme highs, that's about the most expensive those options are going to be the rest of the year, all right? So stay away from that. You wouldn't want to buy a straddle in extreme high implied volatility percent because the probabilities of that volatility coming out rather quickly and soon is a very good and most likely sure thing to happen for you. And if we bought it when it's real high, that volatility comes out, our premium shrink. The underlying may have made a big move, but if that premium comes out, well, we are going to see ourselves lose some money just through the volatility coming out. So the right environment, we want to make sure we are in an extreme low implied volatility percent environment, all right? And the duration, because we're buying an option, we want to go further out the curve, all right? Because when we're looking at these at-the-money calls and at-the-money puts, this is theta decay, all right? Theta is the thief in the night that comes and steals our premium, right? So, well, you can see theta is not very aggressive out here, whereas inside here, we get a big theta decay component, all right? Inside of 35 days, we get a big theta decay component. Yeah, you can see it inside of 7 days. You got a even maybe bigger theta decay component, but there's also gamma in there. So I like to be out of my strategies inside of 7 days to expiration, unless they are basically a total loser, and then you know you got nothing else to lose, ride it out. But we want to get out here outside of, I like to say, outside of 50 days. All right, we want to be outside or greater than 50 days to expiration. All right, that's the sweet spot, because you can see it starts to pick up on that theta decay. And since we are buying, we want to hold on to that theta decay. All right, so we want to go outside of 35 days to expiration. And then picking the right strikes, well, it's pretty easy. We're going to be picking the at the money. But really what I want you guys to come away with is you want to come up with being delta neutral. All right. I don't know what's going on with the pen. This thing is not liking my pen. So I'm just going to have to close that thing out for a minute. So picking the right strikes, we want to go delta neutral. All right, so try and get as close to delta neutral as you can. And then the exit strategy. This is really important because this is something where we need to make a pretty big move. Well, knowing our exit strategy is key. And if you've watched any of my past webinars, you guys know I don't ride anything to full boat. I don't try to get home runs, all right? I like to take little swings. I like to get on first, second, and third. Every once in a while, I'll go for the home run, but it is a rare occasion, all right? I like to get in and get out of my strategies as fast as I can. So what we are looking for in this strategy is I usually look to get out for a 30% increase in my underlying. That's kind of when, or in my strategy here. So you can see I bought it at 14 and went up to 18. I got out. It only went, I was only in this for a couple of days on this particular example. And it's one of the few times that they work out so quick. But here's also another kind of key for you guys to watch. And we're looking at this as being less than 10 days to expiration, and you're at a 10% increase. These are increase in profit. Then that would be a time to start to look to get out. Less than 15 days in, you're at 15% increase in profit. Now, it doesn't seem like we're looking for very much of an increase there. It seems like very small, but remember, we're going to be dealing with strategies that we're paying like $5. So, you know, a 15% increase on $5 is going to go up by about 75 cents or something like that, right? So that's a pretty good day, to be quite honest, especially on a strategy that may have a little bit less probabilities than some other ones. You know, 20 days to expiration, or less than 20 days to expiration, and you're at a 20% increase, I'd look to try and cover that, right? You know, that other one, I was only in it for a couple of days and got that 30%. Well, I'm out of it. I didn't have the opportunity to get out earlier. It just happened very quickly, all right, as we saw just recently. All right, before we get onto the platform and checking out Tesla, we're going to take a look at max profit. It's unlimited, you guys, because the underlying can go to infinity, right? It can go as far up as, you know, Google, or, you know, can go up to Berkshire Hathaway kind of pricing. Our max loss, though, is the premium pay. Okay. On the max profit, if it goes to zero, that's your max profit. You know, so $100 to zero, that would be your max profit also. But the premium paid is always our max loss. One thing to note with the exit strategy, I would also, on an exit for a loser, on an exit for a loss or whatever, I would look at when it's a 50% decrease in the premium. All right. Looking for a 50% decrease in the premium. It's not happening. I'd probably look to cover it, especially if you are a newer trader or have a low risk tolerance. Get out. I may very well say I write it out further than that a lot of times, because usually I believe in my market assumption. All right, so price break even. Remember, we're going to be paying a debit. So when we pay a debit, it kind of works against us. So it's the long call strike plus the premium paid. And then on the downside, remember, it's or, because the market can't go in both directions at the same time. And if it goes to the downside, it's the long put minus the premium paid. And you guys might be saying, hey, listen, that's a tough nut to crack to get to the break even. Well, remember, the break even is at expiration, all right? And I don't write it into the expiration anyway, but just know that you will be able to come out for a nice profit well before you hit even the break-even areas on this strategy, if it happens relatively quickly, or you get that volatility expanding for you, okay? This is just at, you know, the end of the day. I paid a $5 premium. I need to have it be $5 above my call strike or $5 below my call strike just to break even at expiration. All right. So all of those things are about expiration. Like I said, I'm going to be looking to get out well before that on a situation like this. I'm usually just going to look to target that 30%. But again, if you're newer to this strategy, I would look at, you know, this little key here to help you out going forward. All right, so without further ado, let's pull up the trading platform. And this is usually where I say, throw it out there, you guys. Throw me some stocks. We'll take a look at them to see if they work in my all my rules. Oops. So let's close that out. Well, you can see on my watch list over here, I have IV%, which is basically doing the calculation of where Facebook is currently in relation to where it's in the past. We have the code for that you can throw in there and create a bespoke watch list, because you won't find it if you just go and search for it. Another place you can actually find it on Thinkorswim is right here on the options statistics. So you can find that there, 36 IV%. But let's take a look at Tesla. It has really low implied volatility. So outside of 50 days, you know, it's really a pick 'em on what you want to do. I usually go a little bit closer, but outside that 50 days to kind of hold off on some of that theta decay. And it's trading 215.64. So what we're looking here is we already know it has low implied volatility %, but I want to show you guys something here with this strategy. Whoops. I'm going to do the 115s. 115 buy and buy the 115. All right, so we're looking at $37 we're going to have to pay for that. Yes, it's steep. You have to step it up on, you know, these big name stocks. One thing to note, what though, we got to look at this. Decimal 3 ticks to the left, 21 cents to see if it's the right underline. I will say that it usually during open market operations is very close to that. You can see with the volume and open interest. And as a matter of fact, you're actually checking that rule on the 35 days to expiration. So you can see 25 cents, What is that? 25 cents, 35 cents. No, 30, yeah, 25 cents, Wolfman. Can't add today. But during open market operations, I can almost assure you that it is fitting that 20 cent to the bid offer. So that's where we look for it, despite the fact that we are trading out here. All right. So, and even though these are going to be wider markets, just know there's going to be a lot of orders that are in the weeds, that you can't see because somebody might be doing the SEPOC, calendar or something like that, where this October is leaning on the September. I tried never to miss your teachings. Thanks, John. Appreciate it. Oh, you just got here. That's what you're saying. Stuck in a meeting. Did you tell them, hey, I got a time out here? We'll come back. We'll reconvene in an hour and 15 minutes. All right. So you didn't miss a whole lot, John, except for that beginning stuff that you probably already know about, some of the rules that you might want to review a little bit for this one. But I'm going to kind of go over them again here a little bit. But we know we have the rule, tight bid ask, right? We want low implied volatility percent below 50. If you have a lower risk tolerance, we want that IV percent to be below 25 for a stock. If it's an ETF, it's 30 and 15 respectively. But right now we know our break even though, $37, we can add that into the 15. So we've got 52. So on the upside, 252 is where our break even is. And on the downside, we subtract the 37 and we come up with, what is that? 270 something, 273. Is that right? No, that's not right. 283. Is it 283? To the downside. As a matter of fact, we can actually just make it a lot easier on ourselves and go over and look at the Analyze tab like I had for the other example. So let's just go over to the Analyze tab and pull this in a little bit, and we will see that our break evens come in right there at 252 or whatever, and then to the downside 177. All right, so that may seem like it's a big move, but we can look at 177. This would be one of those ideas where we're looking at Tesla and you're like, well, I think it's either going to go and just crater and maybe test this 176 for whatever reason, or it's going to come back up and maybe try and cover that gap. So that 52. So that would be like your big scenario on, I think this is going to be a big move. I don't know what direction. It's either going to tank the lows or it's going to come up and cover that gap. Whatever your reason is for it, right? So I could have that market assumption easily in Tesla for that. So, and you can see that's not that difficult of a move. I mean, especially within, a month or two, 2 months, you can see that $35 was, that was a $100 move, right? Easily made up in something like gold, in Tesla. And we expect the volatility to expand when we usually have those big moves. We want to set it up in a low implied volatility environment because we want that volatility to expand. So here's a reason why we